$38 trillion. The number itself stays abstract because the human brain simply cannot process it as a reality. Let's make it concrete. Physical dimensions. In $1 bills, a single $1 bill is 0.1 millimeters thick. Stack 38 trillion bills on top of one another and you get 800,000 kilometers in height. The distance to the moon is 384,000 kilometers. That stack of money would travel to the moon and back 5 times. Laid end to end, a $1 bill is 15.6 centimeters long. 38 trillion bills placed end to end, approximately 5.9 billion kilometers. That is nearly twice the distance from the Sun to Neptune. By weight, a $1 bill weighs 1 gram. $38 trillion equals 38 billion kilograms, equals 38 million metric tons. The world's largest aircraft carrier, the USS Gerald R. Ford, weighs 100,000 metric tons. This amount of money weighs as much as 380 aircraft carriers. By surface area, a single banknote covers 102 square centimeters. Lay 38 trillion bills side by side and they cover 387,600 square kilometers. That is exactly the total land area of Japan. You could cover the entire country of Japan from one end to the other with $1 bills. The scale of purchasing power the world's most valuable companies. Apple, $3.5 trillion Microsoft, $3.1 trillion Nvidia, $2.8 trillion Amazon, $2.1 trillion Google, $2 trillion. You could buy all 5 of these companies outright. $13.5 trillion. You would still have $24.5 trillion left over. All the real estate on Earth, the total value of all residential and commercial real estate worldwide is approximately $330 trillion. $38 trillion represents 11.5% of that figure, meaning you could purchase roughly 1 out of every 9 buildings on the planet. Compared to national economies, Turkey's GDP, $1.1 trillion, $38 trillion equals Turkey's entire economic output for 34 years. Germany's GDP, $4.4 trillion. $38 trillion equals Germany's entire economic output for 8.6 years. The entire African continent's GDP, $3 trillion. $38 trillion equals Africa's total economic output for more than 12 years. On a human scale, there are 8 billion people on Earth. If you divided $38 trillion equally among every person alive, each person would receive $4,750. For an Ethiopian, that represents more than 3 full years of income. Alternatively, if you spent $1 million every single second, it would take you more than 1,200 years to run out of money. You would have started spending in the year 800 AD, when Charlemagne sat on his throne, and you would still be spending today. What does IT actually mean? The true meaning of this number is not found in its physical dimensions. It is found in how it came to exist. This debt is not a store of wealth. It is a consumption bill. Money already spent in the past, impossible to repay in the present, deferred into the future. And right now, just to service the interest on this debt, the United States is paying over $1 trillion per year, which means the $38 trillion never shrinks. It grows larger with every passing year. Physically, a stack of bills that travels to the moon and back 5 times over. Economically, a weight loaded onto the backs of future generations, one that can never, in any meaningful sense, be fully repaid. Take a moment and truly feel the weight of that number. This isn't a forecast for next year. It isn't some abstract burden piled onto future generations. This is the actual debt America is carrying today, right now. This very moment, recorded in black and white, in government ledgers as of December 2025. Okay, big number. But what does that have to do with me? If that thought just crossed your mind, then you need to listen very carefully to what I'm about to tell you. Because while you were scrolling through social media, jumping from video to video, watching something on Netflix, the world's largest financial institutions started doing something they haven't done in 75 years. quietly, systematically, without a single press release, without making a single press release, without making a single headline. They're moving money. And right here, I need to stop and ask you something. When you heard these numbers for the first time, what did you feel? Shock, anger, or that specific feeling of, I always knew something was off, but I'd never seen it laid out this clearly before? That feeling matters, because that feeling is the sign that you've started asking the right questions. Now go to the comments and tell me, after this video, what stayed with you the most? Which comparison hit hardest? And most importantly, what do you want to see next? Because what this channel does from here on out, you get to decide. Which topic do we go after next? Which number do we put on the table? Which system do we tear apart and show you what's really inside? Tell us and we'll build it. Subscribe. Turn on notifications. Be the first to know when the next video drops, because this isn't just a YouTube channel. This is a window that will keep showing you the things most people would rather not see. And the only thing we need to keep that window open is you. Enormous amounts of it, pulling it out of dollar-denominated assets, redirecting it elsewhere, completely organized, completely calculated, without a word to the public. And if the word conspiracy theory just popped into your head, I understand, but wait, this is documented capital flow, public filings, treasury data, numbers that anyone can access and verify themselves. I'll put the links at the end of this video. You can check every single one. By the end of this video, you will understand 3 things with crystal clarity. Exactly what is happening, why it is happening, and most critically, what comes next. Because there is a pattern here, a mathematical cycle that has played out exactly 3 times in the last 500 years. Same stages, same warning signs, same devastating outcome. And this cycle is playing out again right now, in real time, in front of all of us. The only question is, will you see it coming, or will you end up asking the same agonizing question that millions throughout history have asked while buried under the rubble? All the signs were right there. How did I miss them? Stay with me. The next 15 minutes will permanently change the way you think about money. According to the IMF's most recent data, global debt has reached $251 trillion. That is 235% of global GDP, the highest debt ratio ever recorded in peacetime history. The U.S. debt alone climbed from $36.1 trillion in January 2025 to $38.4 trillion by December, a $2.3 trillion increase in just 11 months. Think about that. In a single year, they borrowed more than the entire economic output of most countries on Earth. But the truly shocking part isn't these numbers. The truly shocking part is this. This exact scenario has happened before, 3 times in modern history. And every single time, the country holding the reserve currency collapsed within 36 months of the smart money quietly beginning to withdraw. Not similar collapses, identical, same stages, same timeline, same end. This is not a coincidence. This is a mathematical law, predictable, repeatable, and once it crosses a certain threshold, unstoppable. Let me walk you through exactly how it works. Every major economic collapse over the last 5 centuries followed the same 4-stage cycle, overlapping almost perfectly with one another. Stage 1, the ascension phase. A nation becomes the undisputed center of global finance. Capital pours in from everywhere. That country's currency becomes the common language, the universal standard of international trade. Everyone wants in. Banks expand, markets surge, innovation accelerates. The future looks limitless. Confidence is total, unshakable. This stage typically lasts 50 to 80 years. Stage 2, the overextension phase. Success, sooner or later, breeds arrogance. The government begins spending far beyond its revenues. Military expansion, foreign interventions, growing domestic programs, all financed with borrowed money. Debt grows faster than the economy. But nobody worries, because asset prices keep rising. Real estate booms. Stock markets hit record after record. Everyone feels rich on paper. Central banks keep printing to sustain the illusion. This stage lasts 20 to 40 years. Stage 3, the silent exodus. This is the critical phase. The smart money sees what's coming, not the public, not the politicians. Just the people who can actually read a balance sheet and see the reality behind the numbers. Major institutions begin quietly rotating their capital elsewhere. No announcements, no press conferences, no headlines. Just a systematic, cold-blooded movement toward safer jurisdictions. Foreign investors shrink their positions. Wealthy families distribute their wealth across different geographies and currencies. The exodus moves slowly at first, almost imperceptibly. Then it accelerates. This stage lasts 18 to 36 months. Stage 4, the collapse. The currency loses reserve status. Foreign central banks dump their holdings. Inflation explodes. Interest rates spike. Asset prices bottom out simultaneously. Banks fail. Pension funds evaporate. The middle class is wiped out. Political chaos arrives at the door, and everyone, standing in the rubble, asks the same question. How did we not see this coming? The answer has always been the same. The pattern was there. At every stage, with every warning sign, it was always there. Now I'm going to prove that this cycle is real, not an abstract theory, but documented historical fact, with 3 concrete examples. 3 empires, 3 reserve currencies, 500 years. Same cycle, same end, the 1500s. Spain, undisputed, unrivaled, the most powerful empire on earth. There was no force on the planet at that time capable of challenging Spain's dominance. Spanish ships returning from the American continent were loaded with more gold and silver than had ever been seen in human history. Some accounts record ships so heavy with cargo they barely made it into port. The Spanish real was the global reserve currency. And this wasn't just a title. If you wanted to conduct international trade, you needed reales. There was no alternative. Madrid was the financial center of the known world. Stage 1 was complete. King Philip II controlled half of Europe single-handedly. Spanish armies were considered unstoppable, not as a figure of speech, but as the military reality of the era. The Armada ruled the seas. Wealth poured in continuously from colonies across 3 continents. So what did they do with all of this staggering wealth? They spent it on everything. Wars with France, wars with England, wars with the Ottoman Empire, wars with the Dutch. A massive military machine sprawling across 3 continents, growing larger with every passing year. A bureaucracy that swallowed fortunes on its own. Palaces that cost entire kingdoms to build. And on top of it all, the Spanish Inquisition, burning money right alongside the heretics. By 1550, Spanish government spending had reached 300% of its revenues. 3 times what they collected in taxes. The gap was filled with loans from Italian banks, from German merchants, from anyone willing to lend. But since gold kept flowing in from the New World, nobody raised an alarm. Asset prices in Spain kept climbing. Everyone felt wealthy. The empire looked invincible. Stage 2 was confirmed. Then, without anyone noticing, something began to change. 1555. The great Spanish banking families started quietly moving their assets to Genoa. The Fugger family, Spain's largest creditors. 1556. The dynasty that had financed the Spanish crown for a century began demanding repayment in gold rather than promises. Not commitments, not paper. Gold, because they wanted out. 1557. Wealthy merchants began shifting their operations to Amsterdam. Not all at once, no one wanted to attract attention. Gradually, opening a small office here, rerouting a trade flow there, quietly moving inventory. 1558. Why? Because they could read financial statements, and the statements said one thing clearly: Spain was functionally bankrupt. The Spanish government was paying 40% interest on some of its loans. 40%. 1559. That is not a sign of strength. That is the confession of desperation bleeding through official documents. Stage 3 was documented. 1557. Spain defaulted on its debt for the first time. Credit markets froze. Spanish bonds became worthless paper overnight. The government seized private gold shipments to pay its soldiers. 1558. Chaos spread through every corner of the financial system, and the king. He promised it was temporary. A one-time problem. Everything would be fine. 1559. Default again. For defaults in 40 years. The currency collapsed. Inflation erased the middle class, one family at a time. The vast Spanish Empire evaporated like morning fog, as if it had never existed. By 1600, Spain was a pale shadow of its former greatness. The Golden Age was over, permanently, irreversibly. It never came back. Stage 4 was complete. Where did the money go? North to the Dutch Republic. Amsterdam became the new center of global finance. Which brings us to the second example. The 1600s. Amsterdam. By every measure, without contest, the wealthiest city on earth. To put a number on it, the Dutch East India Company was worth $8.28 trillion in today's money. More than twice the combined value of Apple, Microsoft, Amazon, and Google. A single company, Dutch banks financed global trade. The Amsterdam Stock Exchange was the world's first. They literally invented the stock market. The Dutch guilder was the world's reserve currency. And this wasn't merely ceremonial. International business required guilders full stop. Capital poured into Amsterdam from every direction: Asia, Africa, the Americas, every corner of Europe. Money-seeking returns found its way to Dutch banks. The Dutch Republic of the 1600s was, in the most literal sense, Silicon Valley, Wall Street, and London compressed into a single city. Stage 1 was beyond dispute. Then the wars came, as they always do, in every empire. Without exception, the wars came. 3 Anglo-Dutch wars between 1652 and 1674. Wars with France on top of that. Wars with Spain on top of that. The Dutch military footprint stretched from Indonesia to Brazil to South Africa. And all of it had one thing in common: it cost money. Staggering amounts of money. Government debt climbed from 4 million guilders in 1650 to 80 million by 1690. A 20-fold increase in 40 years. How did they finance it? They printed. Sound familiar? And then tulip mania erupted on top of everything else. Tulip bulbs selling for more than houses, not as a metaphor, as literal fact. A single rare bulb could fetch 10 times an artisan's annual income. Asset prices had completely detached from any economic reality. Everyone was rich on paper. And meanwhile, the Bank of Amsterdam, regarded as the safest institution in Europe, the most prestigious bank in the world, was secretly lending out depositors' money to finance the wars. They were practicing fractional reserve banking before the term even existed. A Ponzi scheme dressed in institutional legitimacy. Stage 2 was complete. In 1690, the smart money moved. Major banking families transferred their operations to London. The Sephardic Jewish merchants who had made Amsterdam wealthy began to leave the city. Portuguese traders opened offices in England. German financiers systematically, quietly withdrew their capital over the course of years, never drawing attention, never making announcements. Why? Because the insiders knew something the public didn't. The Bank of Amsterdam was insolvent. Not recently, since 1672. For decades, they had been using incoming deposits to cover withdrawals on old accounts. Classic Ponzi mechanics. But the secret was kept until it simply could no longer be kept. Stage 3 was confirmed. 1795. The French revolutionary armies crossed the border, and the Dutch Republic fell. The guilder collapsed. The Bank of Amsterdam's decades-long fraud was exposed. Depositors lost everything. Riots in the streets. Political chaos. And the Dutch Golden Age, 150 years of standing at the very center of the world, ended. Just like that. Generations of dominance, gone within months. Stage 4 was confirmed. Where did the capital go this time? To London. Britain was next. The cycle never stopped. Which brings us to the third example, the most recent, the closest to our current situation, and for that reason, the most important. From the 1700s to the 1900s, the British Empire. The sun never sets on the British flag. Everyone knows that line. But most people never truly grasp what it meant. This wasn't poetic exaggeration, it was a literal geographic fact. The empire was so vast that at any given hour of the day, somewhere on British territory, the sun was shining. At its peak, Britain controlled 23% of the world's population and a full quarter of Earth's landmass. The British pound sterling remained the global reserve currency for over 200 years, the longest any currency has held that title in modern history. The City of London was the uncontested center of global finance. Needed capital for any project, anywhere in the world. Your road led to London. British banks financed railroads in America, mines in Africa, plantations in Asia, infrastructure on every continent. More than 60% of international trade settled in sterling. The gold standard itself was built around sterling. British power appeared infinite, eternal, untouchable. Stage 1 was beyond dispute. Then came the 20th century. And with it, 2 world wars. The First World War alone cost Britain $44 billion, over $600 billion in today's money. They borrowed from America, from their own citizens, from anyone who would lend. Government debt surged from 30% of GDP to 130% in the course of a single war. Now stop and burn that number into your memory. 130%. Why? Because that is precisely the level where America stands today. They tried to maintain the gold standard. It collapsed in 1931. They returned to it briefly. Tried again. It collapsed in 1933. The system could no longer hold itself up. The Second World War buried everything deeper. More debt, more printing, more promises that couldn't be kept. Britain finished that war technically victorious, but financially destroyed. Dependent on American loans just to survive. They had won the war and lost everything else. Stage 2 was complete. In 1949, the silent exodus began. Major British corporations started gradually relocating their operations to America. Unilever, Shell, British Petroleum. Nobody announced we're leaving Britain. They never would. They were simply redirecting investment, shifting capital, growing elsewhere. Wealthy British families moved their fortunes overseas, to Switzerland, to America, to Canada, to anywhere they could escape an island that had become synonymous with punishing taxes and suffocating regulation. The brain drain accelerated. Scientists, engineers, entrepreneurs, academics, all drawn toward the opportunities America was offering. Britain offered high taxes and shrinking prospects. America offered growth and an open door. The choice was self-evident. By 1960, foreign investment into Britain had fallen 62% from pre-war levels. The money was leaving. The talent was leaving. The future was leaving. Stage 3 was complete. 1967. Sterling lost 14.3% of its value overnight. You went to sleep, and by morning, 14% of your money had simply ceased to exist. 1968. The government had no choice. They had completely exhausted their foreign currency reserves trying to defend the exchange rate. The game was over. 1969. Britain went to the International Monetary Fund. Emergency bailout. Think about that. The empire on which the sun never set, the world's greatest financial power, reduced to going door to door, begging for emergency credit like a developing nation. The humiliation was complete, documented, undeniable. Sterling lost its reserve currency status. International trade shifted to the dollar. Britain's century of financial dominance ended and did not come back. Stage 4 was confirmed. 3 empires, 3 reserve currencies. 500 years, the same 4 stages, the same outcome. Spain, the Dutch Republic, Britain, all 3 walked the same road from dominance to collapse, in almost identical steps. Now let's get to the real question. Why is America in stage 3 right now? 1944, Bretton Woods. America became the global reserve currency. The dollar was pegged to gold at $35 per ounce. Every other currency was pegged to the dollar. The system was born. America had won the Second World War. Europe and Asia lay in ruins. Capital flooded into America. U.S. markets became the deepest, most liquid, most trusted markets on earth. Everyone wanted American assets. Stocks, bonds, real estate, treasury securities. The Golden Age had begun. From 1945 to 1971, 26 years of absolute dominance. Stage 1 was complete. Then came 1971. August 15th, Richard Nixon changed everything with a single decision. He ended gold convertibility. The dollar became pure fiat currency. No gold backing, no commodity backing. Just faith in the U.S. government. Just trust. And what happens when you remove all limits? Spending explodes. In 1980, U.S. national debt stood at $900 billion. Sounds large, but watch what follows. 1993 trillion. 2005.6 trillion. 2008, 10 trillion. 2020, 27 trillion. January 2025, 36.1 trillion. December 2025, 38.4 trillion. A 4,200% increase in 45 years. The debt more than doubled in just the last 5 years. But this is only government debt. Only one small corner of the picture. Corporate debt, 13.5 trillion. Household debt, 18 trillion. Student loans, 1.77 trillion. Credit card debt, 1.1 trillion. Auto loans, 1.6 trillion. Medical debt, hundreds of billions more. Total U.S. debt, over $100 trillion. That is 370% of GDP. To put that in historical context, Spain defaulted at 200% debt to GDP. The Dutch Republic collapsed at 250%. Britain lost reserve currency status at 130%. America is at 370%, and still climbing. How are we paying the interest on this? The government now spends over $1 trillion per year on interest payments alone. More than the defense budget, more than Medicare. More than the total budgets of most government agencies combined. $1 trillion, not touching the principal, not paying down a single dollar of the underlying debt. Just interest. How do we finance that? We print. The M2 money supply climbed from 15.5 trillion in February 2020 to 21 trillion by April 2022. A 40% increase in 26 months. The largest monetary expansion in American history by far, for all time. What does that create? Inflation, asset bubbles, wealth inequality. Every single one of these is the signature of Stage 2. Stock markets at all-time highs, while real wages stagnate. Price-to-earnings ratios at dot-com bubble levels. Housing prices up 73% since 2019. Everything inflated. Every asset class simultaneously overvalued. The Federal Reserve's balance sheet expanded from $800 billion in 2008 to $9 trillion in 2022. Buying up treasuries, mortgage-backed securities, corporate bonds, artificially propping up asset prices across the board. Stage 2. Complete, confirmed, mathematical. Now let's get to what actually matters. Stage 3. The exodus. China held over $1 trillion in U.S. Treasury securities in 2013. Today, $760 billion. They have sold over $300 billion worth in the last decade. Documented. Public record. You can verify it yourself. Japan, the largest foreign holder of U.S. debt, has reduced its position by $220 billion since 2022, selling quietly, consistently, month after month. Saudi Arabia is selling. Belgium has reduced its exposure. Switzerland is selling. France is reducing its position. And most strikingly of all, the Federal Reserve itself is shrinking its balance sheet. Quantitative tightening, allowing bonds to mature without reinvesting, draining liquidity from the system. So who is buying U.S. debt now? Mostly the U.S. government itself. The Federal Reserve, government pension funds, a state printing money to buy its own debt, circular financing, a snake eating its own tail. This is not strength. This is desperation. And it isn't only governments. The major financial institutions are repositioning. BlackRock, the world's largest asset manager with over $10 trillion in assets, has restructured its portfolios, reducing U.S. Treasury exposure while increasing positions in emerging markets. European infrastructure, Asian real estate, gold and commodities, systematically diversifying away from concentrated dollar exposure. J.P. Morgan restructured institutional allocations. Goldman Sachs cut its U.S. equity recommendations. Morgan Stanley increased its international allocation guidance. Bridgewater Associates has been explicitly warning about dollar devaluation for years and has positioned its portfolio accordingly. The smart money is moving. Exactly as it did in Spain. Exactly as it did in Amsterdam. Exactly as it did in London. Stage 3 is confirmed. Now let me tell you what happens in Stage 4. No guesswork required. No speculation. We have 500 years of documented pattern, and that pattern draws a very clear picture. The dollar will gradually lose its reserve currency status. Not overnight, not with a single announcement, a single crisis. First, slowly, almost imperceptibly, then all at once. Countries will begin settling trade in other currencies, yuan, euros, bilateral agreements that root around the dollar entirely. And let me be direct. This is already happening. China and Brazil are trading in yuan. India and Russia are settling in rubles. BRICS nations are actively building alternative payment infrastructure designed to function without the dollar. More than 40% of global GDP now sits inside BRICS-aligned countries that are constructing this dollar-free system as we speak. Then there's the petrodollar question. In June 2024, headlines everywhere declared the petrodollar agreement is over. I need to be honest with you about what actually happened. The 1974 U.S.-Saudi Arabia Joint Commission on Economic Cooperation expired. Yes, but fact-checkers confirmed that there was never a formal written agreement obligating Saudi Arabia to price oil exclusively in dollars. It was an informal arrangement, a mutual understanding, a gentleman's agreement. However, and this is critical, Saudi Arabia has recently made clear it is open to accepting other currencies for oil. They have actively explored yuan-denominated transactions. Whether or not a formal treaty ever existed is now beside the point. The practical outcome is the same. The dollar's decades-long exclusive grip on oil markets is loosening. The petrodollar system is cracking more slowly than the sensational headlines suggested, but it is cracking. Now here is the critical mechanism you need to understand. When dollar demand drops significantly, what happens to all those dollars sitting in foreign central bank reserves? They come home. They flood back into the U.S. economy. And that is the moment inflation goes vertical. The Federal Reserve will face the most poisonous dilemma in its history. Raise interest rates dramatically to crush inflation, which makes $38 trillion in debt completely unpayable and crashes the economy. Or keep printing, which destroys the currency through hyperinflation. Both roads lead to the same destination. Liquidity evaporates. Asset prices collapse. Stocks, bonds, real estate, everything simultaneously. Banks fail. Pension funds become insolvent. Insurance companies collapse. The cascade spreads like dominoes. And the middle class, which holds the bulk of its wealth in dollars and dollar-denominated assets, is completely wiped out. Savings evaporate. Retirement accounts disappear. Home equity dissolves. This is not speculation. This is the pattern. And it has played out this way every single time, without exception. Oh, I know exactly what you're thinking. But America is different. We have the most powerful military in history, the most advanced technology, the best universities, the most innovative companies. This time won't be the same. Let me tell you what history has told us, over and over, in different languages, on different continents. Spain, in the 1500s, had the most powerful military on earth, without question. It did not stop the economic collapse. The Dutch, in the 1600s, had the most advanced financial technology in the world. They invented the stock market, central banking, options trading. The inventors of modern capitalism could not stop the collapse. Britain built the largest empire in human history. The Industrial Revolution, a global navy, trade network spanning every continent. The sun never set on the British flag. and even that could not stop the collapse. Military power cannot override economic mathematics. Technology cannot halt currency debasement, but innovation cannot erase the bill that comes due from fiscal insanity. And exceptionalism, the belief that we're different, it can't happen to us, is the story every empire tells itself right before it falls. But the Fed can print infinite money. They'll never let the system collapse. Weimar Germany printed infinite money. Hyperinflation dismantled the middle-class family by family. Savings became worthless paper. A wheelbarrow full of cash couldn't buy a loaf of bread. Zimbabwe printed a $100 trillion banknote, a completely worthless piece of paper. Venezuela printed. Inflation hit 1,000,000%. People ate zoo animals to survive. Doctors and lawyers worked as taxi drivers. Argentina printed. Multiple currency resets. Decades of poverty, despite holding some of the world's most abundant natural resources. Printing money does not create wealth. It redistributes it from savers to debtors, from workers to asset owners, from the middle class to the financial elite, until trust breaks. The moment trust breaks, printing doesn't slow the collapse, it accelerates it. Every empire has believed it was different. Every reserve currency has believed it was permanent. Every single one has been wrong. The pattern does not listen to narratives. It does not require your consent. It does not wait for consensus. It works like clockwork, like mathematics, like gravity, completely indifferent to whether you believe in it or not. And right now, every indicator is screaming the same thing. We are in stage 3. So what does this mean for you, practically, concretely, starting today? First, assess your exposure. If the majority of your wealth is in dollar-denominated assets, you are exposed. Not might be, you are. Diversification is no longer a standard piece of advice your financial advisor uses to bore you. This is a matter of survival. Move toward assets that hold their value during currency debasement. Gold has preserved value across every civilization, through every crisis, for 5,000 years. Silver, commodities, real and tangible assets that cannot be conjured into existence by a central bank printing press. Second, think about geographic diversification. If the world's largest institutions are moving capital internationally, at least consider following their lead. Not all your money, some of it. Research stable foreign currencies. The Swiss franc, the Singapore dollar, the Norwegian krone. Don't concentrate your political risk in a single jurisdiction. Third, understand the timeline. Stage 3 does not last forever. Based on historical precedent, from start to finish, 18 to 36 months. Based on when foreign selling meaningfully accelerated, we are likely 12 to 15 months into this process right now. That means you have time, but not years, months. Don't waste them. Fourth, increase your liquidity. Keep accessible cash. Yes, it will lose value to inflation, we know that. But in a crisis, liquidity gives you options. Buying collapsed assets at the right price. Moving fast when you need to. Not missing the window. Illiquid assets lock you in place precisely when you most need to move. Fifth, reduce your debt. In a rising interest rate environment, high debt is financial suicide. If you are leveraged, start deleveraging now. Every point interest rates rise makes your debt more expensive to service, and rates are structurally going higher from here. Sixth, invest in human capital. In every major collapse history has recorded, the one asset that proved resistant to inflation was human capital. Skills that create genuine value, knowledge that solves real problems, relationships built on trust. These cannot be confiscated by governments or eroded by central banks. Seventh, stay informed. The people who navigated these transitions successfully were always the ones who saw what was coming early, who understood the pattern before the mainstream confirmed what was already obvious from the data. Subscribe to this channel and turn on notifications because the next video will break down, one by one, the assets that have historically performed best during Stage 4 collapses. Which ones preserved wealth through hyperinflation? Which ones destroyed it completely? What happened to gold during Britain's collapse? What happened to real estate during Spain's defaults? What happened to stocks during every major currency crisis in recorded history? All of it, with data, with documentation, because the pattern repeats. The cycle does not stop, and if you know the pattern, you can position yourself correctly. This is not fear-mongering. This is 500 years of economic history showing you the same film over and over, different actors, same script. America's debt reached $38 trillion for a reason. Foreign central banks are selling for a reason. Major institutions are diversifying for a reason. They are all seeing the same thing, the same pattern you just learned, the one that destroyed Spain, that destroyed the Dutch Republic, that destroyed Britain. We are in stage 3, the silent exodus phase. The smart money is leaving. The warning signs are everywhere, for anyone who knows what to look for. Stage 4 is coming. The mathematics are inevitable. The only question is, will you be positioned correctly when it arrives, or will you end up asking the same question that millions throughout history have asked? All the signs were right there. How did I not see them? The information is here. The pattern is clear. The data is verifiable. The choice is yours. Leave a comment below. What you think, what you're doing to prepare, where you disagree, what questions you have. I read every single comment. Subscribe and hit the bell, because the next video covers 3 specific sectors that have historically outperformed during currency crises. Sectors that could protect your wealth from what's coming, or, if you position yourself correctly, even turn it into an opportunity. The pattern doesn't care whether you believe in it. It doesn't need your faith. It doesn't require your acceptance. It just keeps moving forward, exactly as it has every time before. And remember, the people who survived these transitions were not always the ones with the most money. They were the ones with the best information and the courage to act on it.